This is National Net Lease Market Overview, State of the Market. This is a great panel. Randy's gonna, from Boulder Group is gonna moderate. I will kind of flash their info up here, but you can also remember, go see this in the lobby so you can get at their information there. Stop share. All right, there's, you can see me double. That's kind of fun in the background there. So Randy, are you there?
I'm here.
Excellent. Well, take it away. If you need anything, my friend, I'm in the background.
Thanks, and thanks for having me. Am I on the video screen?
No. There you are, Randy.
All right. Thanks, RA Journals, for having me, and thanks for hosting the National Net Lease Summit, the virtual version. You know, all my panelists are here, so I think we'll just jump right in. You know, Gordon, I think I'll start with you, which is, you know, the topic of the moment, unfortunately, is still COVID. You know, I want to get your thoughts on, you know, your COVID's impact year to date and kind of, you know, how it's impacted your thinking for, you know, now and well into next year as well. So, Gordon.
Thank you. You know, it's been very interesting to see what's happened here, right? To see what sectors have performed, what haven't performed. You know, we've been fortunate in that 100% of our tenants have paid 100% of their rent, and we, you know, have a variety of different business sectors. So that's definitely factored into our thinking. You know, I think really the conclusion that I've come to is, you know, our focus on industrial has really proven to be quite good in terms of lessening the impact of COVID. You know, and I think that'll be our focus continuing forward. You know, interest rates are continuing to be low, and I think these continue to be great investments and will continue to be great investments in the net lease sector, right? You obviously have to pick and choose. We've never been big fans of retail. Look, obviously, people are still going to buy things, people are still going to sell things, and it's just going to be different. You know, but as we said just a few minutes ago, you can't wipe out an entire, you know, you shouldn't wipe out an entire asset class, right? So there will be some winners in the retail space, and you know, if you spend your time focusing on it and trying to pick who they are, I think you can do well. I mean, it's a sector that we're probably going to stay away from, with the exception of, you know, distribution warehouses for retailers, just because it's not really our area of expertise, figuring out which retail store will be the one to succeed. But I think certainly industrial going forward is going to be, you know, excellent investments.
All right, Gordon. So how's it kind of impacted your firm as far as, you know, working and fundraising, to the extent that you've been doing fundraising, you know, kind of how's COVID changed things to date?
You know, it's an interesting question. In terms of fundraising, we did just finish up fundraising our fourth dedicated net lease fund. You know, we raised $1 billion of equity, which was great. We were really happy about that. We had our final close September 30th, right? So it's 6 months of, you know, finishing up fundraising during COVID. We were fortunate that we'd done, you know, a lot of in-person meetings before and things like that, and fortunate that we have, as a firm, have a lot of repeat clients and in the net lease business as well. So that's very helpful. But I think you're going to see a sea change. The virtual meetings went very well. You know, it's a little harder to build a connection with somebody who's a first-time investor with you, but you can certainly do it. And I think that certainly for investors that you have a relationship with, I think you're going to see so many more of those meetings taking place over the internet. I think you're going to see it, you know, the need to travel to all those places greatly decrease. You know, quite frankly, it really helps keep people's schedule, right? I mean, if you're getting on a plane and you're flying to see somebody and your plane's delayed, right? You show up late, they're still going to see you because you've flown in from wherever you're coming from, but it messes up their whole day. And here you're able to really maintain your schedule, and I think it works well. And so I think you're going to see a change there. In terms of
And
our office,
what are investors looking at as far as, have their perceptions of net lease changed in regard to COVID? For retail aside, meaning, are they more enthusiastic about net lease? Are they more enthusiastic about industrial? What is the impact of COVID on fundraising investors?
it's been interesting, right? I mean, I look at, the sector we have historically played in is primarily less than investment grade, right? So you looked at some investors who said, hey, we want yield. This is a great way to get yield. We think interest rates will stay low. You're going to get a great spread, right? So we're going to continue to go ahead. Some people say we're going to double down because we really like it. And then you had others who said, hey, great investment, really like it, but I think this is the time to play the distressed credit market. To which my response was, you kind of get the best of both worlds if you focus on net lease with less than investment grade tenants, right? Because, it's really I really view it as a credit play at the end of the day, but you've got the security of owning a hard asset. And so a lot of investors started to think that way. But then you just had others who just said, hey, you know what? We just want pure play distress. We're going to go ahead because we think it's a good time for it.
So I'll get to everybody else in a second. Just one more question, Gordon.
Yeah.
Impact of your actual firm as far as communication, staffing, how you've been able to cope with the challenges that we faced?
Sure. So, as a firm, we're here in New York City, right? So we've got not only state regulations, but city regulations. The city says you can have 50% capacity. So our office has been open at 50% capacity purely on a voluntary basis. And as a multi-strategy firm, right, you've got real estate, net lease, distressed debt, CLOs, CDOs. It really depends on kind of what your strategy is, right? Anybody that has more of a trading strategy, right, those people tend to be coming to the office. The firm's done a phenomenal job in terms of making sure that it's safe, clean, things like that. Got great protocols in place. And so the more trading strategies tend to have, the majority of their people there. Others that don't, it's kind of a mixed bag. Some people, particularly younger people, like to come into the office. Older people or people who have other health issues tend to stay away. But in terms of communication, it may seem a bit counterintuitive, but certainly as a group, I actually think we're communicating more. And the reason for that is, we now have a daily call, whereas before we had a weekly meeting and you talk to people during the day. So I think more people, have a better idea of what's going on. It may not be as sort of in depth for some people, right? Because, if you saw them, you just walk over and say, hey, let's talk about X, Y, Z. But I think on the whole, there's actually more communication than before, and it's actually worked out well. And we're fortunate that we've got a team that's been together for a long time, worked well. We have onboarded, 3 other people during COVID, which has actually gone well, integrated well, and everybody's working well. So, it actually does kind of show that, if you need to, you can work remotely and not have a major disruption.
Thanks. Brian now. Brian, maybe you want to talk about, impact of COVID on your firm, on your outlook, kind of on how things are to date and AR Global. Thanks.
Sure. Thanks, Randy. I think generally speaking, our business has been relatively unaffected. We have 2 net lease strategies on our platform. One that focuses primarily on retail, one that focuses primarily on industrial and office. And both of them have been extremely durable and resistant over the last 9 months. Rent collections, we've also been extremely fortunate that our rent collection is extremely high. And, I think we look back to where we've been focused over the last couple of years, heavy on industrial and in the retail space, very selective in terms of the types of assets we were investing in, focused primarily on gas and convenience, auto repair, and dialysis, among others, which have all held up really well. So, that's enabled us to stay really consistent and true to our strategies over the course of this whole thing. We did spend, an awful lot of time over Q2 and Q3 tracking rents and just talking to our tenants. And I think while there was a shift in our day to day, there was a lot of positive that came out of it. The relationships that we've been able to kind of build upon with our tenants has been a real benefit to this whole situation. Some of the conversations start with potential deferrals, but they end with, well, when we come out of this, we're going to be looking at doing this and we're going to be looking at doing that. And, we need partners like yourselves to help us get through those things. So we're starting to see the benefit of that now. A number of our tenants are coming to us looking to take advantage of opportunities within their respective businesses, trying to grow their footprint by buying competitors. And obviously, that's where we step in, either through M&A sale leasebacks or expansions of their existing facilities on the industrial side. But either way, that's something we always welcome and we're always looking to do with our existing tenants, because those are exclusive opportunities that no one else is seeing. And, that's a great way to spend our time and allocate capital.
So, and I'm speaking louder because someone said that in the comments that can't hear me. You from the tenant feedback and from all the meetings you've had, will you be changing your acquisition criteria in Q1 and Q2? And kind of what other changes will you be making based on conversations you've had the last few months?
Not really. Like I said, we're fortunate enough to have been focused on the areas within the real estate, the broader real estate asset class that have held up really well. So, we've always focused on investment grade and credit quality tenants, which is obviously a place that, you can feel more comfortable than others right now. So we'll continue to focus on that space. But we'll also continue to focus on the asset classes within real estate that we've been focused on to date. Industrial, we're not going anywhere on industrial. Maybe we'll be a little bit softer than we already were on office. But generally speaking, I think we're gonna stay the course.
Thanks. Okay, now we'll go to Andreas. Kind of give me the W.P.Carey version of how COVID has impacted you.
Sure. I'm not going to sound terribly original after some of my colleagues just spoke, but it hasn't been very disruptive for us. We've got a nearly $20 billion portfolio, and our rent collections have been in the 98-99% rate, which we're quite proud of. For me personally, the biggest disruption was we did go on pause for a little bit out of an abundance of caution. We had a really good pipeline built coming into this pandemic, and there's a little bit of a reset there. That being said, we've recovered nicely. We've been very active in the market on the acquisition front, but also in the public debt and equity markets. We've raised nearly $400 million of equity. We did a $500 million bond offering that I believe was the lowest coupon in net lease history, obviously benefiting from where yields are, but that was about 2.4%. We're all spread investors here, so to be able to lock in an attractive cost of capital in this environment, notwithstanding the disruption, has been beneficial. I think we've also benefited to being a partner, having been in the market for so long, having transacted, having very good relationships with tenants and brokers, as a known trusted quantity out in the marketplace. With an uncertain backdrop like we're seeing right now, companies, brokers, no one wants a false start, no one wants surprises, and so to be able to come in and provide a bid that has a tremendous amount of certainty behind it, and trust with your counterparties, has allowed us to I think do a little better than market on some of our recent acquisitions, and continue to be aggressive on the offensive. And so definitely a bit of a setback in the early part of the year, but we're trying to be aggressive and make up for lost time.
Thanks. Anything else for the next 6 months that you're going to change because of what's going on today, or it's more of the status quo?
No, I think it's the status quo. I mean, similar to Gordon and Brian. I mean, we are underweight retail, underweight office, mostly industrial, which has performed well. Something that Gordon and I have talked about on this panel in years past is lease structure. The lion's share of the deals that W.P.Carey does are sale leasebacks, where we're originating the lease, we're writing the lease, we're ensuring that all the protections that you don't really think about until an event like this happens are in place. And I think this event has demonstrated the resiliency of the portfolio and the rigor in the underwriting and the writing of our documents. And big chunk of our portfolio is sub-investment grade, and we've come out quite nicely. And so I think there's a greater appreciation in the marketplace for the importance of proper structuring. And now you actually have events that you can point to that are tangible for why certain protections in the documents are required. So I think, going forward, that will be a theme. But in terms of asset allocation, we're going to continue to do what we're doing. We invest in Europe as well as the United States. Spreads in Europe are phenomenal right now. And so, all our money is fungible and we'll allocate it as we see the best risk return. But right now, we're seeing good opportunities, across the globe, and, look forward to building a strong pipeline for 2021.
Thanks. Last but not least, Aaron, same question to you. And maybe you can give a quick commercial as the newest of these firms that are here on, kind of one family.
Of course. I hope you can hear me well. I know some people working from home tend to maybe sometimes not have the best connection, but you can hear me?
We can hear you fine.
Okay, good. Well, a little bit of background about us. One Family Property, since its inception earlier this year in 2020, has acquired about $30 million of net lease, with about $40 million in our pipeline to acquire over the next, I'd say, 30 to 90 days, really. And, I know everyone on the panel quite well. Obviously, we're all either in the net lease retail or net lease industrial space. And I think we kind of all have our thoughts and kind of comments about the space. One thing, I'd like to just acknowledge is, the previous panelists kind of mentioned it. We shouldn't take broad strokes and range and look at things in kind of a holistic big picture. You really got to get into the micro and the guts of really what's going on. So to say, retail's not thriving or not doing well, Amazon with their acquisition of Whole Foods is a great example. Whole Foods is doing incredibly well. And you just look at there's a large kind of pool of retailers who are thriving and doing incredibly well throughout the pandemic. You look at Walmart, you look at Costco, you look at a variety of these retailers who, comp positive are doing incredible, and they're best in class retailers. They're, to Brian's point, they're investment grade and they're the best in class. They're not the mom and pop retailers maybe who are in a shopping center. And unfortunately, due to the pandemic, a hair salon, a nail salon, those tenants, we can all, I think, agree, aren't going to necessarily do so great in a pandemic where you're supposed to be social distant and not be, crowding together in group settings. But to say a grocery store, a convenience store, or a pharmacy is not going to do well, I can't buy that. And I don't think that anyone on this panel or anyone who's signing into this would get on board with believing that that's, the future of this space. So, to be really truthful and honest, I'd use another term someone else used. I really see a portion of the net lease space being unaffected. And that's, again, the top quality tier tenants. And most of them are S&P rated. They're Fortune 500 companies, and they're doing billions of dollars in revenue and have figured a way to take offense as opposed to being on the defense and saying, put our hands up, we can't figure it out. I think, in addition to that, Randy, to your point and Gordon's point, stimulus seems like, another round could be here, could be imminent. And I think most importantly for our country, we need to get the dollars and cents into people's hands that need that money, because they have been depressed by this pandemic, and they need the ability to get out and spend and pay their bills and bring food home and put food on the table. So
thanks. All right, let's keep going to the next question. Gordon, back to you. Kind of looking for, a lot of us deal with existing product and the reselling of it, on the smaller retail side is a lot of our experiences. But kind of want to touch base on where we don't play as much, kind of the sale leaseback market, what you're kind of seeing from tenants, and, the financial situations of the different tenants who are looking for sale leaseback, and what you think transaction volume in sale leaseback market looks like for the next few months. Gordon.
Sure. I think sale leaseback volume will go up, right? I mean, really, at the end of the day, sale leaseback, is really an alternative form of financing for companies. Companies need liquidity. What we saw was that early on in COVID, we did see a big pickup in volume. And I think you had, the smart companies, the smart CEOs, CFOs were looking at this and saying, hey, this could go for a while. We have no idea, how this ends up. Let's shore up our balance sheets today. Let's do a sale leaseback and let's get some liquidity. Some of them have been sitting on the cash. A lot of them paid down debt. And some of them, have taken the the opportunity to acquire a competitor. But I think, the next several months, you're going to see, a big uptick in the origination of sale leasebacks.
There's not an issue of deteriorating balance sheets of some of the sale leaseback prospects, or these are actually getting done and the credit's still good enough for the majority of them.
No, they're getting done and the credit's still good enough. I mean, look, we play way down the credit spectrum, so we spend a lot of time looking at that, and that is, it does take a lot of work. But you got to look through and look at the fundamentals of the business and see, okay, here's the path to, either remaining the way they are, or here's the path to getting better, or say, you know what, there seem to be too many headwinds here. It's time to pass on this one. But yeah, I mean, depending on the industry, depending what's happening. I mean, if you look at the numbers that we saw in the presentation before, right? I mean, you've had an uptick in in revenues year over year for some of these industries. And I mean, some of our tenants had their best best quarters ever, which seemed a little bit counterintuitive, but it really kind of depended the area that they were in and how the public looked at what product they produced, what they thought their need for that was going to be going forward. All
right, so you still think it's a robust market next year and will be significantly better than this year, is kind of your thoughts?
I do. I really do. I mean, companies need liquidity. You're still able to get financing out there. And so I do think it's going to be I think it's going to be a great year next year for sale leasebacks.
I like the optimism. Brian, are you seeing the same thing?
Yeah. I think Gordon nailed it in terms of, where these companies tend to be heading and the fact that leads to sale leasebacks more often than not. Companies come to sale leaseback financing as a way of shoring up balance sheets. But I think the other thing that we're going to see that's going to add to that is going to be all the M&A that comes out of this, which is another way that we see sale leasebacks, obviously, right? I mean, some companies are going to come straight to the sale leaseback market for their solutions throughout all this. Some of them won't make it, and that's going to be buying opportunity for those that do, right? And that's the type of sale leaseback that we tend to do, partnering on an acquisition, whether it be with a PE firm or with an underlying operator buying a competitor. And I think that's the type of deal that we hope to see come more often. And I think we will heading into next year for sure. So I think there are going to be a couple of different ways that we're going to see sale leasebacks continue to rise, and it all looks positive in terms of volume from where I'm sitting.
Andreas, any different thoughts?
No, I would agree with that. I mean, there's certainly some haves and have-nots in the market right now. And I think the companies, like Gordon was saying, some companies have had their best quarters ever, and they're being offensive and going out and raising the best capital they can. I mean, I agreed with the sentiments on M&A. I think one of the things that's going to help the net lease market, I mean, the deals that we're doing are typically 15, 20, 25 years in duration. And so if you think about, we're in a historically low yield environment, we have an uncertain backdrop, and execution for the most part, if you have a viable narrative for how you're going to get through this pandemic, is good right now. And so if you're trying to lock in a good source of capital and have visibility on your operating costs on your borrowings for a long horizon, there's no product in the sub-investment grade space that gives you that kind of visibility. I mean, if you go out in the debt markets, you're going to get 5-7 year terms. That's it. You've got a balloon at the end you have to repay. It's often floating. You just don't have that rate locked in. So I think for that reason, there will be a big uptick, and I think next year is actually going to be a monster year in sale-leaseback origination. In terms of people being
office, industrial, and retail, or any specific?
No, industrial will continue to drive things for the next 12 months. I mean, and I agree with the sentiment that there are retail transactions that make sense. I did one last year that was for Bass Pro. It was their largest store in all of North America. I've done deals with companies that have less revenue and EBITDA than this one store had. I mean, it's just an absolute beast, and it was really kind of the backbone of their operations in that geography. And so that's an example of where you can take kind of unique collateral retail market where there have been headwinds and there is pushback, but there's a very clear story for why they're going to perform differently no matter what the headwind is than some of the other competitors that kind of get flooded with this anti-retail narrative. I'd say the same with office. I mean, there are office transactions that do have a criticality component. It's hard. It's not every deal, but if you have an office with some specialized lab integrated into it, or just a very unique employee base, or a data center, or disaster recovery, you have a helipad on the roof. I mean, there are things there are elements you can find in these deals that certainly fit the criticality narrative that we're all looking for, and give you a security profile not too dissimilar to industrial. It's hard to put $1 billion out only doing industrial. It's competitive, and you have to have an open mind to some of these other asset classes if you want to continue to build a pipeline.
Thanks.
I'll give quickly an example of a deal we did earlier this year that I think is a good example of a company whose business line and narrative was a good one and was well received by the market and went out and was opportunistic. And it's in everyone's backyard in Chicago. It's for Weber Stevens, Weber Grills. Everyone knows. I've seen more Weber Grills throughout this pandemic than I think I've ever saw in my life. Everyone's outside, everyone's grilling. They were doing phenomenally well, and so that was a deal. We love the real estate, the iconic brand. No matter what the backdrop is, that's a deal you can go into and feel really good about it. If properly structured, that you're gonna have a great risk-adjusted return. And so no matter what's going on, there's always good deals to be had out there.
Thanks, Aaron. Last word on sale-leaseback market. You're muted, Aaron.
All right, there I am.
There you go.
Yeah, Randy. I think that maybe you and I on the panel kind of maybe on the similar side of things with this, but for the most part, I see a lot of in the I'd say retail, kind of smaller. When I say retail, I mean the retail buyer or consumer in the net lease space. The $1 to $10, the $1 to $5 million private buyer that doesn't exist on this panel really is not necessarily always in that industrial space looking to place or allocate 25 million. Or might not be in the data center space. They might be looking at sale leasebacks in the $1 to $5, $10 million range. And I think a lot of that is going to slow down in certain sectors, and that might be the controversial casual dining per se. Again, smaller credit, maybe some chain restaurants. Do I think quick service will continue to thrive? Of course. The pandemic showed it, and I think that sale leasebacks will still occur in the quick service restaurant space, the C-store space. Again, the larger price point deals, the data centers, the industrial centers, life sciences, biomed, that type of stuff, of course, that's going to continue to thrive. And I can agree with every panelist that, next year should be a banner year with just a multitude of reasons, and a perfect storm being interest rates at historic lows or continued historic lows, and a kind of a supply constraint it's been existing over the last 7 years. You really didn't have that much development and new build really coming from 2015 to 2020. There's only so much product out there, and developers kind of the last 3-4 years have decided to not dig into the ground and decide to increase their costs on a projection of 30%. So second gen space and operators who want to access that capital and deploy it, tap on that equity they have in that property. I think again, sale leaseback market that should thrive next year. So.
Thanks. All right, we had 5 questions, and we're only probably going to get to 3. So I guess we're in crystal ball territory for what's people's projections for the next 3 months and 12 months. Gordon, we'll start with you again.
You mean in terms of volume or in terms of?
In terms of volume, in terms of where your competitors, in terms of, kind of where the market evolves into over the next, short and medium term?
Okay, I think in the short term, right, you're coming up on, calendar year end, which for many companies is fiscal year end, right? So as folks know, that tends to be a driver for decisions. So they can, go to the market and say, hey, we're starting the year off with XYZ. We've shored up our balance sheet, we've done this, paid down debt. So you've got a big push. I mean, we're fortunate we're still able to close by year end. People are focused. We'll buy your property and give you your cash before 12/31. So I think you're gonna see a big push, certainly the next 3 months, because then you get the deals that don't actually get done by 12/31, because people don't think about it until December 1st or December 15th, and it rolls over. And as Andres said, I mean, I think it's gonna be a banner year next year, right? I think with the vaccine, we're starting to see the light at the end of the tunnel. And I think folks can say, okay, instead of, people thought there'd be a vaccine, but now you've got sort of much better idea of when that's going to start coming out, right? It seems to be getting, this seems like they'll get FDA approval sometime soon. You have a start date. I mean, look, it's complicated to deliver the vaccine to 300 million people, right? And then there's issues about at what temperature do they need to be done and things like that. But I think you're looking at it and you say, okay, if we can get through 2021, we're going to be good. And so I think, because it's an alternative form of financing for companies, they're going to say, hey, let's do the sale lease back. Let's have the cash. Let's make sure we make it through. So you're going to, I think you'll be, 25% to 50% larger in 2021 than you had, last year.
So do you think, I get your opinion about the sale leaseback market being more robust next year. Do you think the competitive environment becomes more robust as well? Meaning, do you have more competitors who are fundraising that you'll be competing against, or do you think you're just going to get a greater market share?
Well, I mean, being better, I think we'll just get greater market share. But no, to me, I mean, I've never understood why people would want to own multifamily, right, or office, or multi-tenant stuff. I mean, when you can have a sale leaseback, because I think it's such a great investment. People are chasing yield, right? So I think you're going to see, and look, over the last decade, right, this has really become an institutional product whereas originally it was much more of a retail product. So I do think you're going to find more and more investors coming into the space. And, look, we've got a pretty bifurcated market, right? I mean, folks tend to have their niche. And so, yeah, there'll be some more competition, but, as Andres had said, people want certainty, brokers want to make sure that they can deliver to their client what they say they're going to do. And so I think you'll see, people going with firms that have performed historically in the past. But sure, I mean, like with any great product, you'll have more and more people coming into the field. And I think this is a great product. I mean, it's really withstood the test of time. It really delivers a great return, steady, stable income to investors, and it provides liquidity pretty quickly to owners that are doing sale leasebacks. And so, yeah, I think you'll see more competition both from investors and new firms coming up.
Thanks. Go to Brian. Crystal ball for the next 3 to 6 months. What changes?
Yeah, and I think sentiment is similar to what Gordon mentioned, but just kind of piggybacking off of where he was going. I think in terms of competitive landscape, there will absolutely be more and more groups out there chasing the product that we all chase. I don't think there's a question that net lease is continuing to grow as more of a common asset class to be focused on by more generalist groups. But I think
competition will be public companies, private companies, individuals. Where do you see the most competition coming from?
I would say probably just generally institutions trying to get into the net lease space just because of the secure cash flow and the durable income that comes from it. But where I was going with it is, back to what Andre said earlier, and I think Gordon echoed it as well. We're all known commodities here. And over the last 9 months, I haven't seen the fact that we are a known commodity be as important in years past as we have over the last 9 months, right? When we're in a competitive bidding process for a deal, the fact that we're a known commodity matters much, much more than it did prior to this. And I think that continues. So while there might be more entrants and more competition, I think in a lot of cases, especially in the sale leaseback space, where it's more nuanced and you're writing leases and you're originating the deal entirely, it's going to take a known commodity in order to take it down. So those new entrants might be there, but I see them as more of noise than anything. When push comes to shove, I think as a broker, as a seller, as an operator, when you're looking for a partner in a deal like this, especially right now, it's going to be of the utmost importance to go with the known commodity. So I think we'll all benefit from that as we head into 2021 and we see this volume continue to grow, even if there are new entrants in the background.
Thanks. Andreas, to you, kind of what do you think is where's the industry headed in the next few months?
No, I would echo, many of the sentiments that my competitors have shared. I mean, if you think about what's happened in some multifamily, if you think about what's happened in some retail and some office, there had been capital flows for the last, as Gordon was saying, it's gone from more of a retail product to more of an institutional product. That's been a trend that's been taking place for over 5 years. This has accelerated that. I mean, I think people see the virtues in that lease. They see the resiliency of the product in the face of an event like we've all just gone through. And, I'm seeing on deals where I'm hearing that there are competitors who I never would have expected to be in my sandbox coming in. And so I think you have capital flows from, other asset classes, multifamily, office, retail, but I think you also have people just seeing the virtues of net lease as a product class generally. I mean, I started my career in investment banking. I was at Credit Suisse in a fixed income seat, looking at, originating high yield debt for, some investment grade companies. And if I think about that, the risk return on that, on high yield paper versus what we do, in light of how much, monetary stimulus has been pumped into the economy. I mean, no one's really talking about inflation, but if inflation does pop up, it was mentioned earlier that, the Fed has moved its target to allow inflation to run a little hotter over the 2% target. I mean, if inflation does come back, net lease with, built-in escalators, whether they're fixed or CPI index, provides, I think a much safer risk return for fixed income profile investment than just straight debt. And I think a lot of people are seeing that. And real estate has its other characteristics. You can lever it. There's other things about it that help the return profile. And so I'm optimistic that these capital flows will help my cost of capital and help me be competitive. But I'm also realistic in knowing that it's not going to get easier. And I think that there's going to be it's going to be a bit of a knife fight for deals over the next 12 to 18 months.
Aaron, since you're like me, more focused on the retail part of the market, any different perspective?
Hot. It's going to stay hot. I think that you'll appreciate this, Randy, and I think that a lot of the my colleagues and peers on the panel can appreciate it as well. But when you look at the kind of trajectory of the last 10, 15 years in the cycles, you saw really 08, 09, 2010. Kind of you're out of it. You're starting to coast up. 11, 13, 14, 15, really hot years, some of the hottest cyclical. Just we're at the top of it. 17, 18, a lot of the people on the panel themselves couldn't buy because it was just in excess of what they wanted to because of how hot the market was. And I think that it's very, very clear to say 18, 19, was kind of the screeching slow halt. 20 just kind of stopped for a lot of people. So I think that 21, 22, we're going to kind of go up. And I just kind of see it as being the start of, again, a bottom or a low. And, we're going to ride this wave. Who knows, God willing, 8 to 10 years and I can retire. So
when you say go up next year and it's going to remain hot, do you still think it's going to stay bifurcated where, obviously the Walmarts and the Chick-fil-A's are in huge demand, but, obviously you can't give away a health club. You still, that continue or the secondary product are rising as well?
I think the cap rates are going to stay historically low. Interest rates are incredibly low. People are starting to become more and more educated about net lease as an investment and as a strategy. Where can you go out? I say to people, who are interested in real estate, most people don't get into real estate for a 6, 7, 8% return. They get into real estate to take risk. So in our space, everyone on this panel and everyone here, for that matter, in the net lease industry, to take little to no risk with JPM or whatever organization who is your tenant, and you're getting that 3, 4, 5%, that's a great risk when interest rates are at 2%, 2 3/4, 3%. So and then you have the bump. So bottom line is, I think to get back to your point, Randy, yes, I think it'll be a bifurcated market. I think there'll be a lot of buyers in the space, and I think people will come from, as Brian said, office, industrial, multifamily, retail, shopping center developers and owners, and they'll all be looking for something more passive and something that they can just kind of worry less about where their income's coming from.
Again, I want to thank everybody else for at the end of the panel. Thank Real Estate Journals for hosting us, and appreciate all the people who participated. Thanks again.
Thanks, Randy.
Thanks, Randy. Appreciate
Thanks,
it.
Randy.
Thanks, guys.